In this video, I'll be going over the best strategy for beginners in order to make the most amount of money as possible. We'll be covering a strategy that statistically has the least amount of risk and the most amount of upside. And we will also be covering 3 key principles that you must know in order to make profit on your investment. So without further ado, let's jump right into the video. So there's a lot of different stocks and it is impossible to know which one will be going up or down. To be specific, there are currently listed over 6,000 companies on the US stock exchange. So to choose one and hope for the best may result in you losing all your hard-earned money. But don't worry, I'll be sure to give you enough information so that you will know what to do when investing in stocks after watching this video. Before we can learn the strategy, we need to know what stocks are. A stock is a piece of a company that you can exchange for money. We can say that a company is like a cake. If you would like a piece of that cake, you would have to trade your money in order to get that piece. But let's look at a real scenario. Let's say that Apple has 1,000 shares and you purchase 100 shares for $10 each, which is $1,000, and you therefore own 10% of the company. Now, Apple comes out with a new phone that is a lot better than expected, and the piece of the stock jumps from $10 to $12. You now have made 20% on your $1,000 investment and can cash out $1,200. This method is called capital appreciation, which is the difference between the purchase price, which was $10 in this example, and the selling price, which was $12. The other method is called dividend income. Dividend income is when you purchase a piece of a company that gives out money for holding the stock. This is either paid out monthly, quarterly, semi-annually, or annually. You can search on Google for companies that pay out dividends and you will find many results there. Personally, I've used both methods, and after 3 years of investing, I've averaged around 10% yearly, even though the markets have been dropping. You see, I started back in 2020 on February the 15th, which was 20 days before the corona pandemic hit. It was catastrophic. My investment plummeted down 40% and it was my first ever stock purchase, and I was scared. But luckily, I had done some previous research before going into the market. And as I said in the beginning of this video, there are 3 key principles that you need to know before entering the market yourself. And the first key principle is to buy and hold. You see, the stock market is used to be going up and down, but when we look at the historical chart, the stock market has annually been going up about 8 to 12% per year. 3 years later, to holding on to the very same stock, it has went from minus 40% to now plus 20%. The second most important principle that you need to know before entering the market is that time in the market beats timing the market. There are many people claiming that when you're trying to find stocks, you should try to buy low and sell high. But that is some of the worst advice that you can listen to. And here's why. There was a study done from 2006 to 2021 in which they showed how much you would earn in the stock market starting with $10,000 for a 15-year period. If you simply invested and didn't touch that money after the 15-year period, you would have a 10.66% yearly gain and a total of $45,682. But if you were trying to time the market, therefore buy low and sell high, and you would miss just 10 of the best days in the market, your total return would have been only $20,929, which is half if you would have just bought and hold your position. Therefore, when you're buying stocks, it is better to have longer time in the market rather than buying low and selling high. The last principle that is important to have in mind before I can give you the strategy is to know about compound interest. Compound interest is a universal rule that is extremely important to know about, especially when you're investing in the stock market. Compound interest means that combined interest of both the money put in the stock and the money you make from it. It can also be explained as interest on interest. Let me show you what I mean. So when you invest $1,000 into a stock, you most likely will have a 10% gain on that investment after about 1 year. You will then have $1,100. But after 1 more year and another 10% gain, you will not have $1,200, but you will have $1,210. This is is compound interest working its magic. It is kind of like a snowball effect. The bigger the snowball, the more snow it can take and the faster it grows. Here is a calculator showing you how much money you start with and how much you want to add each month. Let's say you would like to invest $1,000 and add $100 each month. If you didn't invest the money, you would have $13,000, but if you did invest the money, you would have a total of $22,739, which is almost double. Now that you know all the 3 most important principles, I will show you the best strategy to use when investing in the stock market. And the best strategy to use when investing is called passive investing. Passive investing is when you choose a portfolio for about 5 to 15 safe companies that you put money into every month without selling before it has been a time period of at least 5 to 10 years. Safe companies are also boring companies that has an annual stock price growth of about 10%. Personally, I can't tell you which companies to buy because you always have to do your own research. Now that you have all the information you need, the only step left is to get started. When getting started, you either have to be 18 years of age when opening a broker account, or you have to get help from your parents. When finding a broker account, the best way is just to search on Google the best broker accounts in your country. When you are buying individual stocks, there is a small fee you have to pay every time you buy and sell. But if you're buying index funds, you should be aware that some index funds are charging you a higher fee than others. So check that out before you buy. When you are investing, you don't need to check your phone every day to see that if your stock is going up or down. Remember that you are buying and holding for the long run. For my last words, I want you to do as Warren Buffett did. He built his wealth over a long period of time, and that is what made him the richest investor in the world. Don't fall into the trap of easy gains or fast money. I've done that plenty of times, and I promise that if you're not careful, you will be losing money just as I did. Thank you for watching. Make sure to hit that like button so you can make other people financially independent, and also subscribe. It's free and you can always unsubscribe later.